Hello, fellow RoboCapitals. Hope you're well. New inflation data really moving the markets. And we've got a lot of people talking about how the Fed, with a new Fed chair possibly, is going to run the economy hot. And what does that mean for the dollar, for interest rates, for future CPI? So we're going to go ahead and go through the data today, but we're going to try to look out into the future and ask the question, what happens next? The all-important question. All right, let me do the screen share. Josh is swiping on Tinder somewhere, or maybe Grindr. You decide which one is probably more accurate. And while Josh is swiping on Grindr, we're going to go over to, where do we start? Let's do CPI. Or excuse me, let's do CNBC. So punchline, guys. The expectation was for 2.5%, month over month, 3%, and it came in low. It came in low. Now, you may be asking yourself, George, in the thumbnail, you're talking about running it hot. Well, how can you say that when the CPI came in lower than expected? Aha! That's what we're going to look out into the future. We're going to get into that next. But let's go into the dirty details here. Consumer prices rose 2.4% annually in January, less than expected. The consumer price index for January accelerated. Okay, we got that. 0.3 percentage points from prior month, the lowest since May of 2025, excluding the volatile food and energy. In fact, I'm shocked. How? What? They said food and energy without prefacing with volatile? What is going on? Whoa. That's the big news of the day. Forget the CPI. All right. All right. All jokes aside, to get back to a core CPI was up 2.5%. So headline 2.4, core excluding the volatile food and energy 2.5%. Economists surveyed by Dow Jones, yes, we know they were expecting a 2.5. So let's get into the charts, guys. Get a visual representation of what's going on here. This was way back summer of 2022. And we've got to pat ourselves on the back for this one at this channel, because I was really talking about inflation here and the cerveza sickness, lockdowns, the government's response to the cerveza sickness causing the supply shortages, which really juiced prices, along with all the stimmy checks, excess aggregate demand, artificial, temporary aggregate demand, by the way. And then right here, kind of all that stuff stopped. So I thought to myself, well, I'm going to take a more disinflationary stance. That's my base case. And since right about here, I've said, look, we probably float around this area until we get something big. You know, we get UBI. All right, now I'm going to go ahead and get back over to the inflation camp. And if we get a big recession, okay, we're probably going to drop under 2%. But if we don't get either of those, if we're in this kind of holding pattern, I don't know why we'd go below 2.4, 2.3. And I don't know why we'd go above, call it 3.2, 3.3. And that's exactly what we've done. Exactly what we've done. So as far as our inflation prediction that we have had on this channel, we've had it spot on. We've had it spot on, pretty much going all the way back to the cerveza sickness. So that's really good. But you can see the trend here, and that's what I want to highlight. The trend is obviously disinflationary. Now, I know a lot of you are saying, oh, George, this understates inflation. Yeah, I get it. I get it. And I totally agree with you, by the way. But what we're doing here is we're not saying that goods and services are going up by 2.4%. Look at the CPI. That's not what I'm doing. I'm saying we are seeing disinflationary pressures override everything else, meaning that right here, the real rate of inflation was probably higher than 9%. And today, the real rate of inflation, probably 2.4. But the trend is most likely the same, still the same. Okay, so now let's keep going here. And we're going to look at the kind of the monthly figures and you can see this big ramp up with CPI peaking with the month over month at 1.2, and that was back in the summer of 2022. What we're just saying, and then it really falls off a cliff And then since that time, lower. We had a couple negatives in here, by the way. And then we get this 0.2% today, month over month. So they point out that there's some economists that say this could be attributed to the government shutdown. And I don't know. They're always trying to just give some excuse as to why something happened, weather, blah, 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 blah. And then, of course, they always have to try to throw Trump under the bus. So they're going to say, oh, well, the inflation rate would have been lower. It would have been right around the Fed's target if it wasn't for Trump's tariffs. Now, are the tariffs contributing to prices being a little higher than they otherwise would be? Probably. But my point here is whatever Trump does, they're just going to be, they have to always kind of take a stab at him or highlight something that they perceive to be negative. It's something we just expect from the mainstream media. They say at the macro level, U.S. has shrugged off slow start to 2025. At a macro level, it has shrugged off a slow start, in 2025, and has been barreling forward ever since. Really? Now, I know that GDP is sky high, and that looks like we're running on all 8 cylinders, but I would ask you guys right now in the chat, do you feel like the economy is booming? Do you feel like in 2025 we were off to the races? My guess is probably not. Okay, let's get back to it here. What I want to do now is go over to the let's go over to the actual calendar here, just so we can get the overview. And what we're looking at right here, you can see the 0.2%, month over month, what we were talking about, the annual 2.4, and then the core at 0.3, and then the 2.5. That's what we're referring to earlier. But now let's go over, now that we've seen the trend, right? Now let's go over to this idea, because I hear it all the time on the mainstream media and especially in social media, where the Fed is going to try to run it hot. They're going to run the economy hot. We always hear this. They're going to run the economy hot. Well, why are they going to run the economy hot? Well, because the debt's too high, because the debt is unsustainable. So we need to run the economy hot, and therefore that gets debt to GDP down. What's interesting about that argument is we never stop and ask why we want to get debt to GDP down. Like, why? Okay, it's based on the way you calculate it, 100%, maybe 120%. Why do we want to get it down? Now, I'm not saying that we don't or we shouldn't, but I'm saying why? What's the reason that most people would give as to why we want to get the debt to GDP down? Well, they would say the debt is unsustainable. Okay, what do they mean by that? What they mean by that is if we hover around these levels, let's just say 100%, 110% for a certain amount of time, or if it continues higher, let's say 120, 130, then all of a sudden we are going to cross this magical threshold in the treasury market where interest rates at the long end of the curve will just skyrocket. Because the debt to GDP is just too high. And if interest rates skyrocket, then this creates this doom loop where the interest rate on the debt goes higher, the overall debt. And that means that now all of a sudden that the tax receipts, let's say it's $3 trillion a year, are 100% go just to pay off the interest on the debt. And then what's going to happen? Well, then the treasuries bust, and then no one's going to want our treasuries. And then we're going to have to issue more because we've got to pay higher interest on the debt, but those get continually higher interest rates because no one wants our debt. And therefore the Fed has to come in and do QE. And then that crashes the US dollar. So we all understand, we've all heard this narrative 1,000 times, but what we have to start with is the fact that all of this is predicated upon the debt to GDP crossing some imaginary threshold and blowing up the bond market. And what that means is there would need to be a disconnect between growth and inflation expectation and yields. So even though yields have been trading on growth and inflation expectations for the last 75 years in the United States, all of a sudden, if we're at 120% debt to GDP right now, if we get to 121, then all bets are off. And we're after 75 years or 100 years or however long you go back, the whole history of the United States, our treasury market is traded on growth and inflation expectations. Once we go from 120% debt to GDP to 121%, all that changes. All that changes, and the treasury market is no longer going to trade off of growth and inflation expectations. You see, this is what the whole argument is predicated upon. And the fact, or not the fact, but the idea that the Fed controls interest rates and the Fed controls the rate of inflation. Okay, so now that we've established that the fundamentals there of the analysis and the narrative, let's go ahead and read this article. Because now what we're doing is we're trying to project out into the future to see what inflation will be, let's just say in 6 months, a year, something like that. So this is Daval is the guy's name, of BCA Research. I don't know who this is, but the headline here on his Zero Hedge post is Warsh likes it hot and will move the Fed's inflation target to 2.5 to 3.5%. Okay, and maybe he does move the target from 2.5 to 3.5%, but immediately you see the flaw. And the flaw in this logic is that the Fed will somehow meet this target. So now let's think it through. The Fed has had an inflation target, I mean, ever since I've been even watching this stuff, but they obviously had an inflation target throughout the 2010s. Were they ever able to meet that inflation target? The answer is no. No, maybe they did a quarter or something like that, maybe a month. But for the most part, from 2010 to 2020, they weren't able to meet their inflation target. For them, inflation was too low back then. Remember those days? And then all of a sudden, we had the cerveza sickness and the inflation rate skyrockets. I mean, we just saw a chart of that going back to this CNBC article. That's what we see right here. And then inflation is way above the 2% target. And to this day, it's still above the 2% target. So wait a minute here. So for the last 15 plus years, 15 years, the Fed has never, ever been able to meet their inflation target. Either they've been too low or they've been too high. It's 15 years. We're not talking about 15 months, 15 years, and they've never been able to do it. But yet now, all of a sudden, moving forward, we're supposed to assume that if the Fed wants to get inflation from 2.5 to 3.5, or if they want to get inflation to 2 or 1 or whatever they want, they're going to be able to do it, even though they haven't been able to do it for 15 years. Let's keep going here. So the Fed will run the economy hot as if they can, or as if they can just turn that dial, because the labor demand supply now imbalance, both demand and supply must expand to keep output expanding. And then this assumes that they control the labor market, that just by them going out in there and raise or lowering interest rates, that's somehow going to give this massive stimulus and boost to the labor market. Okay, well, let's think that one through, because the Fed has been dropping rates all of 2025. Remember 2024, what was it? September of 2024, going into 2025, they dropped interest rates by 100 basis points. And then how many rate cuts did they have in 2025? Right at the top of my head, what was it? A couple, 2, 3, something like that. So they, since September of 2024, let's just say they've cut interest rates by 150 basis points. 150 basis points. Okay, great. What has the labor market done since that time? It's tanked. It's fallen off a cliff. It's negative non-farm payrolls. It's all these things that we talk about on this channel all the time. So the labor market is in shambles, even though the Fed has been dropping interest rates. So again, you see what I'm saying? It's the Fed's only tool here is really QE or dropping rates. And when they talk about the labor market, they're really more so focusing on the rate side of that. So even if they do drop Fed funds, are we to assume that this is going to somehow impact the demand supply balance or imbalance? No, well, it's never done it in the past. So why should we assume that it'll have some effect in the future? You see, and what this always goes back to is that interest rates don't control the economy. You guys know this, interest rates are a reflection of what's happening in the economy. So here we go. Let's keep going. Short-term U.S. real rates will come down further because the Fed will continue to cut, even though inflation, with inflation from 2.5 to 3.5%. And this assumes they can get at that level. And today we're at 2.4. The U.S. dollar will continue to weaken, given the currency's dependence on real interest rate differentials. This is another fallacy. I don't mean to pick on this guy because he's just reiterating all these mainstream narratives that you hear all the time. So I don't want to really single him out. But let's think that one through, because do interest rate differentials matter? Yeah, some of the time. But then other times they don't. Like, let me give you a great example. Let's go over to CNBC. And let's go ahead and look at the yen. So you guys know that the Bank of Japan has been raising rates. And the Fed has been cutting rates, like we just said. But during the last year or so, has the yen appreciated dramatically, as you would expect with the interest rate differentials? No, it's flat. And by the way, the only reason it's flat is because the Bank of Japan has come in and their politicians, their central planners, on multiple occasions and said that they're going to prop up the yen because the yen was getting too weak against the dollar. It was getting to 160. So they had to get in there, take their FX reserves and try to sell dollars by yen to try to prop up the yen against the dollar. And this is while their central bank is increasing rates while the Fed is decreasing rates, which if it was all about interest rate differentials, you would have seen the yen skyrocket relative to the dollar, meaning in this chart, the yen, this chart would have gone down because this is how many yen there are to $1. So you would not see the yen at 152. You'd see the yen at 100. You'd see the yen at 90, something like that. So my point here is that this whole idea, this hypothesis, is also dependent on something that isn't always true. I mean, this is never true, that the Fed can control how hot the economy is or how not hot. And the Fed controlled the labor market. That's never, ever true. But the interest rate differentials, sometimes so, sometimes not. And over long periods of time, more so not. So you see, and this is what we do. We build these narratives based around things that we present as though they're fact and as though they're just written in stone, when often it's the complete opposite. Not only are they not written in stone, that these things that we present as just given rules are the opposite is usually true. Okay, so the U.S. dollar, we got that. U.S. yield curve will undergo bear steepening as U.S. inflation expectations ratchet higher. So here I got to give him credit because he's not talking about the reason for the long end of the curve blowing out like most people, where this is just due to debt and deficits and issuance and foreign sovereign wealth funds dumping treasuries and all these things. He's just talking about it going up due to growth and inflation expectations. So there, give them a big round of applause. Meaning T-bonds would underperform cash. Okay, stocks would continue to perform. And then he goes into it. So the reason, and by the way, this is the chart that he gives showing that labor demand is now more so in line with labor supply, where demand has been way higher than supply for many years, which most people would say would not necessarily lead directly to consumer prices going up, but it would be an inflationary pressure. Because if demand is so much higher than supply, labor, then the only way that that can sync up is if the employers offer higher wages, okay, or just reduce workers. So, but the thing here that we're not noticing is we're assuming that this is going to stay the same. And now that we've met an equilibrium, that this is just going to be flat on a move forward basis. And I don't know. I mean, I don't know. I'm looking at this chart and it seems like it's going one way, especially the labor supply. Labor demand is flattened, which ain't a good sign. But then we see labor supply just go from the bottom left to the upper right, almost in a straight line. So why should we believe that this light green line will just flatline from here? I mean, if we follow the trend, isn't it going to go up? If this goes up and this stays flat, now all of a sudden you've got way more supply than you have demand. And instead of being an inflationary pressure, that would be a disinflationary pressure, if not a deflationary pressure. So then again, how does the Fed get the inflation up to 3.5% in that type of environment? Well, regardless of the environment, the Fed can't control it. But even if they could, it would be a lot harder for them to do so. All right, so now let's go over to the bond market. And this kind of ties things in a very nice bow. So over the last 5 days, let's look at that. This is the 10-year Treasury we'll use as a proxy. Right here, you guys know what happened because you're watching my videos. This is when we had the surprise for the jobs market for the non-farm payrolls. It went up to 130,000 when the expectation was for 55. So, whoa, knee-jerk reaction. What are you going to have? Growth and inflation expectations increase. So you would expect exactly what we saw, and that's for the yields to go vertical. But then what happened is you dig a little deeper into the report and you see, oh my gosh, look at the revisions. Yikes. Then what do yields do? They go down even further. And then what happens is today we get a lower than expected CPI and yields go down even further. So right now we're trading at 4.06 when after the knee-jerk reaction from the non-farm payrolls, we were up at 4.2. So you got to ask yourself, let's just say it's a 14 basis point move. What caused this? What caused this? Did we somehow reduce the deficit? Did the Dutch Sovereign Wealth Fund all of a sudden say, oh, instead of selling treasuries, we're going to start buying treasuries? Did Scott Bessent say that he was going to issue fewer treasuries in the future? Did we lower the debt? Did the debt to GDP go down? No, none of those things. In fact, all the opposite. The sovereign wealth funds are still dumping. The central banks are still dumping. The debt and deficits most likely are increasing, or at least the expectations aren't for them to decrease. The debt, I can assure you, the debt hasn't gone down. And so the only conclusion that you come to is, oh, it's about growth and inflation expectations. It's not about debt deficits, issuance, or dumping. And if it is about that, then most of the narratives around the bond market or interest rates or inflation, disinflation, inflation, their starting point is incorrect. So now let's go back to the CNBC and let me give you my prediction. Oh, we're kind of bouncing around here. I forgot there we go. Perfect. So where would I say we're going to go from here? Honestly, I would keep it the same in that I don't see why we'd really get above 3.3, and I don't see why we'd get below 2.3 unless something really changes. So if we have a recession, an economic contraction, especially one that is defined by the NBER, then you're going to see it go below 2, not just 2.3. I would definitely expect it to go below 2%. And then if, I don't know, Trump comes out with stimmy checks or UBI or something that's not just deficits, but it's velocity, just like we had during the cerveza sickness, then all of a sudden I would expect it to go higher than 3.3. But those are really fundamental kind of shifts in the economy. So outside of the fundamental shift, something major happening, I don't know. I think we just kind of are in this range for the indefinite future. You guys know my base case. If I had to choose one, are we going to accelerate nominal GDP due to velocity from stimmy checks or UBI or something like that? Maybe, but I would err on the side of the economy slowing down, not speeding up. Therefore, I would be in the camp of disinflation, not deflation, but disinflation as measured by the CPI. Not that I buy into the actual price increase that is reflected by the CPI. Those are two different things. All right, guys. I want to remind everyone that we've got tickets on sale for Rebel Capitalist Live. This is going to be the incredible event at the end of May. My goodness, who are the speakers here? Look at these guys. Woohoo! We got Brent Johnson, my good buddy Kiyosaki, Darius Dale there for the first time, Jeff Snyder, Rick Rule, Mike Green, Barnes. I'm sure he's going to be talking about Epstein, that's for sure. Kenny McElroy and Hartman talking about real estate. We're going to have a few more speakers that we're going to add to the list. So, guys, this is an event that you are not going to want to miss. You got to get your tickets ASAP because as we get closer to the event, you guys know the drill. The price goes up. So, Josh, we'll go ahead and put a link in the chat and in the description of this video. Head over there, get your tickets ASAP, and I will see you at the end of May in Orlando on that bombshell. Enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism, and we'll see you in the next video.